أعوذ بالله من الشيطان الرجيم بسم الله الرحمن الرحيم الحمد لله الصلاة والسلام على رسول الله السلام عليكم ورحمة الله وبركاته. Okay, the next topic that we're going to discuss is ethics in financial reporting. And you may have heard that there's been some scandals in the past 2 decades which made the global economy suffer because of some actions of some individuals that were not ethical. And the economy suffers if the investors lose confidence in the corporate accounting because of unethical financial reporting. That means if you're provided with the information, the accounting information, and the information is inaccurate, or you cannot trust the information, then you cannot invest with confidence. So people take their money out of the economy, and as a result, the economy suffers. And this can be this people pulling out their money from the economy and closing down businesses, etc. This can be for many different reasons. For example, we are in the midst of a situation which is not because of accounting scandals and so forth. It's because of people don't know what will happen in the future, how this pandemic is going to pan out eventually. So people are uh, cautious in investing money, and when this happens, the economy stops or it slows down. And I'm sure you have heard at the turn of the century there was the scandal of Enron, WorldCom, Health South, AIG, and others, where these are big names, big businesses, where they had many investors and stockholders, and they did not report their accounting information accurately, and they misreported the information. As a result, when that thing uh, was exposed, their lies were exposed, the business went out of business. As a result, the investors suffered. So, to counter that, the US Congress passed a uh, set of guidelines. It's called the Sarbanes-Oxley Act of 2002, and it's still in place. Sarbanes and Oxley, these are the last names of two um, individuals who came up with the law of governing the companies and so forth. And as a result, many new rules came out. And the bottom line is you cannot actually impose ethics from outside. This is something that people have to um, be internally motivated to do. If somebody is trying to hide or trying to not report a loss or show additional profit, it's very difficult for someone to control that from outside. So these laws are there, they help, but they cannot prevent the unethical practices 100%. And the effective financial reporting depends on sound ethical behavior. And ethical behavior is something, as you know, it comes from within. It comes from the individual. And in every business, in every profession, right, whether you're in the pharmaceutical business or in the oil and gas or in biomedical field, no matter where you are, you have the option of doing your job properly and disclosing all the information to people who need the information, or you have the option of hiding. And nobody can monitor you 100%. Another human being cannot monitor you 100% from outside, right? So ethical behavior is something that we put a lot of emphasis on. And before we even talk about how to prepare the accounting information, we discuss this because an ethical dilemma is something that, because of your work experiences, most of you have come across this in some capacity, I am sure, right? Um there are three steps usually in handling the ethical dilemma. The first one is to recognize an ethical situation and the ethical issues involved. Now, if you're faced with a situation at work, right, where either your boss or your co-workers or someone is either themselves doing something or asking you to do something, right? Uh, then you find that this request that they're making of you is not something that you feel well about. You have a personal ethical standard and you don't feel that this should be done, right? Now, I'm going to pause for a second. If any one of you would like, without naming the detail of any names or companies or anything like that, but if any one of you would like to share with us a situation, then please go ahead. Share with us a situation if you faced a situation where somebody asked you to do something and you did not feel well about it.
I had a situation once. Um, Actually, I was asked about some account information, and it felt like there is no harm is wanted from this question, but it's a question from a person, from a colleague actually, about a relative account. The account is for someone who's relative to my colleague. So this, to me, as a banker, this is a complete a breach of my ethics, because these kind of information are very sensitive, and especially to close people, to the account holder, because you never know what this might lead to. So I politely refused, and I explained why. It was taken in a good gesture, I think.
Very good. Excellent. Excellent. Anybody else? Yes. Go
Can you hear
ahead.
me?
Yes. Miss Mariam, go ahead.
Okay. Yeah. Because for me, the microphone is showing. It's okay. So for me, there I was put in a situation where I was asked to do something that it wasn't like to do with accounting, but it was more of I was asked to assess somebody's level of language skills without them knowing. So for that, I felt personally it was against my values, because if I was to test somebody's language, I would give them an exam or a presentation or something where they can be tested more effectively. So it's not subjective to me. So what I did was, because this was a request from um, somebody higher than me, I recommended different approaches and how to get to the results that they wanted.
Very good. Very good. Excellent. Miss Ala has her hand raised up. Go ahead.
Yeah, I don't know if this is an ethical issue that you mean here or no, but because we have an access to the medical records of the patients in the hospital, many patients are asking for the COVID-19 results of their relatives, and we are not in the place that we can tell them the results. I'm not sure if this is an ethical issue.
No, it is, of course.
Mhm.
You see, in all of these situations, if you go to the second point, and thank you all of you for sharing this information, this experience of yours. You see, the second point, it says identify and analyze the principal elements in the situation, which means identify the stakeholders, persons or groups who may be harmed or benefited. Ask the question, what are the responsibilities and obligations of the parties involved? So in each one of these cases, you ask this question that, is it going to wrongfully benefit someone? Is it going to harm someone? Is it right for me to do? So you ask this question. That's what the second stage is. And you're faced with the situation. The first question is you feel, and subhanallah, uh, a good individual, a good person, which all of you are, inshallah, you automatically will feel some discomfort with a request which is not ethically sound. So that is the recognition of the situation. There's something not right about this request. The second stage is what you just gave examples of, right? Ms. Sausan, Ms. Maria, Ms. Ala, all of you gave examples of uh, either the bank customer or the patient or the relative of the patient. They had either they did not deserve to know this, or it would have harmed one party or the other. So you identified, right? And then you went into the third stage, which says identify the alternatives and weigh the impact of each alternative on various stakeholders. So in each one of these situations, you acted in a way that would have not harmed, right? You identified an alternative, you identified a solution that was the most appropriate solution uh, for the people involved, as well as for you, because like Ms. Mariam said, if it was a superior who's asking you, you have to be tactful to handle the situation. Otherwise, you might be harming yourself as well, right? So, in any situation, and because you're all going to be uh, in your own fields, in a management position, not necessarily directly handling accounting data, inshallah, you will not be put in a very direct situation where you're asked to record something that is not correct. But you might make a decision in that regard. So it is good to know that you have handled situations like this before. Okay, now we go into the hardcore accounting items. Are you ready? Are you ready?
Yeah.
Yes, yeah.
All
Yeah.
right, very good.
Yes.
Now we have, right, uh, a few items that I'm going to give you the first introduction to, and there are two uh, primary statements. One is balance sheet and the other one is income statement, and underneath each there are certain items that are recorded, and we're going to get details of these accounting items. Now, I'm going to give you a snapshot. There are more than two statements. One is the balance sheet, the other is the income statement that we have on this slide. But there are more. We're going to discuss four, including these two others. But those two statements are either generated from these two statements, or one of them is a part of balance sheet and the other one is generated from these two statements. These are the core, the two statements, and these are the two statements that I'm going to ask you to prepare using the accounting software, a few weeks from now, inshallah, and you will be ready for it, inshallah. It will be easy. You should not worry about this course, inshallah. If you come and you put in a little bit of time, not extreme, amounts of times. I know you are busy and you have other courses, but if you come, inshallah, I'm going to try to make the information such that you almost grasp it during the class, inshallah. We have here uh, three items under the balance sheet. The first one is an asset. Now, just simply define an asset. Is an asset is something that you own, right? And it can give you some benefit either now or in the future or both, right? For example, if you have a building, right, you may be renting out the building or you may be using the building, so it's an asset. If you have cash, that's an asset, right? If you have an accounts receivable is someone that owes you money. So a customer bought something and they have not paid. Now, until you get that money, you cannot use it to benefit yourself. But when you do get it in the future, you will benefit from that money. So an accounts receivable is something, right, An accounts receivable, let me just type it in here. An accounts receivable is something that is going to benefit you in the future, inshallah, when you get that money from the customer. So it's an asset, right? If it's not clear, any one of these items, if it is not clear, please stop me and ask me to explain or give you more examples. I'm going to assume your understanding, and I'm going to continue.
I
And
just
I'm
had
going
one
to,
question.
yes, go ahead.
About the accounts receivable, is it the money itself or is it the organization that owes you the money?
Okay, tell me the first thing again. It's either
Like accounts receivable, is it defined as the money that another organization owes you?
accounts receivable is money that is owed to you by an individual organization, the money that is going to be coming to you in the future. They either bought something from you, uh, or you have somehow provided them with a service and they haven't paid yet.
Paid
So
you.
that's
Okay.
accounts receivable.
Okay. Thank you so much,
Okay?
doctor.
No problem. Ms. Shaista, go ahead.
Yeah, will it be like your monthly salary will be account receivable
No, no,
kind
no,
of
no.
thing?
We're not. See, when we are discussing this, we're talking about from the company standpoint, right? So
Hmm.
we're not talking about an individual, right? You
Okay,
obviously do not have a balance sheet and an income statement, neither do I, right?
okay,
So we're talking about from a business's standpoint, right?
okay, okay.
Okay, go ahead, Miss Ella.
Doctor, I
Yes,
have a question. Is it the receivable or what's the name? Yeah, account receivable. Is it example of it is the loans for
it's
the
not a
bank?
loan. Accounts receivable,
No.
no. Accounts receivable is due from a customer who either bought something from you or you
Mhm.
provided them with a service and they haven't paid yet. So that's accounts receivable, money that you will receive in the future, inshallah. That is called accounts receivable. Clear?
But for the bank, the loan cannot be an
This will come in a
example.
different case.
Like
No, this is
different
different. I
thing.
will come to that, inshallah.
Okay.
Doctor, can we consider like when we do online shopping,
Hmm.
and we buy things and we do not pay at that time to
If
that
you do not
portal, something
pay,
like
I mean, if you pay with a
mm-hmm,
if you buy something, let's say you bought
mm-hmm,
something from Lulu and they haven't
mm-hmm,
delivered the item yet, right?
mm-hmm. Okay.
If that is the case, then it's not accounts receivable for them yet. They had to have provided you with the goods or the services for it to become accounts receivable,
Suppose if I buy something from Amazon and I
yeah,
have chosen cash on delivery
right?
and yeah, yeah, sorry, I got it. I got it. I was thinking something else. I
Okay,
cleared the question itself. Yeah,
no
thank you.
problem. Yes, go ahead. Uh, Someone else has a question. Go ahead. Miss Mai? Miss Mai, I cannot, if you're talking, I cannot hear you. You can type your question, inshallah.
Yes, can you hear me now?
Yes, 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 I can hear
Yeah,
you. Go ahead.
because I hear this account receivable a lot during working in a bank. Because let's say because I am working in a guarantee scheme, which they give a claim for a bank. So this account receivable work in this situation that you can claim this loan and will be in their account receivable until the client pays the money back and then the bank will return the money in this account.
Right. So in the banking industry, the accounting is slightly different than your regular industry, because in every other industry you have a product or a service for which you exchange money. The situation with the bank is the money is the product, right? So in the situation of the bank, there is no other product. The product is the money, right? Miss Mai, are you following?
Yes, I'm
Right.
following.
So in the case of the bank, the accounting is slightly different. So we cannot get into the details of that. That is something that in your finance class will be more appropriate to discuss.
Okay, got you.
Okay.
Thank you so much.
Okay.
Thank
No
you.
problem. No problem. Miss Sausan.
Yes, doctor. If you allow me to give an example, just a very
Go ahead.
simple one, so it might be more clear. Um, let's imagine we are in a small village where everyone knows each other, and there is a grocery shop. So the owner of the shop or the seller, sometimes he sell goods to a family who still does not have the money to pay back. So he write it on a book, for example, until the end of the month once the salary is in, so they can pay him the price of the good. So I think this is maybe a simple example
Yes,
of
absolutely.
the, yeah.
Absolutely. That's a very good example. Excellent. That is correct. Okay. Excellent. So we have an asset, right? Accounts receivable is an example of an asset. Buildings, cars, computers, all of those are assets, right? Something that you own and you can benefit from. Something that is a something that is due that you have to give is called a liability, right? So a loan, for example, an example would be a loan. So if the company borrowed money from the bank, then it will be a liability. It would have to be paid back to the bank. So the assets are things that the company owns. The liabilities are things that the company have to pay, the company owes. The difference between the two is called equity. So let's say the company has a very simple example. Let's say the company has $10, which is an asset, and the company has a $5 loan, right? Then the equity will be $5, right? $10
Yes.
asset, $5
Yes.
liability, 10 minus 5 equals 5,
Right.
5.
right? That means you have $10 in assets, but actually your ownership of that is only $5 because you have to pay the other 5, right? So that's what equity is. Equity is what your true ownership is in your assets after you have paid your liabilities. Is this clear? This is a simple, very simple example of explaining the equity. Is that clear?
Yes.
Yes.
Yeah.
Okay, very good. So these are three items we have. In the income statement, we have,
Doctor,
go ahead.
can you repeat again the definition of the liabilities here?
The liability is anything that you owe, anything you have to pay, right? Any loan, anything you have to
Oh,
pay, right? Either now or in the future, it's a liability. Clear? Okay. Now we have in the income statement, right? We have the first item is revenue. Revenue is any money coming from your sales or services. So the customers give you money for buying goods or services. So you stand in the line at the supermarket and you're paying the supermarket cashier. This is revenue for the company. They're getting the revenue. You're paying them for the goods that you purchased. Expenses are things that they pay, obviously very simple. They pay for the inventory, they pay for their the salary of their employees. All of those are expenses. So the sales, which is the revenue minus the expenses, equals to income if the revenues are more. And if the expenses are more than the revenue, then we have obviously a loss, right? So these are all the accounting items, and we're going to expand from this. There is no other accounting items outside of this, and there are many different ones under each one of these categories, and we're going to look at more details in just a few minutes, inshallah. Okay, so let's move on. In every business, we have three different types of activities: financing, investing, and operating. And the accounting information system, the job of accounting information system is to record and keep track of all of these different types of activities, right? And we're going to discuss what is involved in each one of these different types of activities, some examples of each one of these different types of activities. Any activity the business does, any, can be put into one of these three activities: financing, investing, and operating. Okay, let's dig a little bit deeper. A financing activity involves funding the business. So you can get the funds to start the business from two sources. Number one, you can borrow the money. You can go to the bank and you can borrow money. In that case, you're going to have a loan, which is a liability, and you will have a creditor, which is the lender. The bank that gives you the money is the creditor. And then you will have on your balance sheet something called a notes payable, right? Or a bonds payable. These are two different types of uh, loans that you can get. And this, you're going to learn more about the differences between these two and so forth, but it's basically a loan. So any loan, right, that you get from a creditor is the bank or anybody. It could be an individual that lends you the money, right? It could be another company, not a bank, that lends you the money. In that case, they're going to be the creditor. So you're borrowing the money from the creditor and you have a liability, which is the loan. That's the first way of funding your business. The second way of funding the business is you sell your stock to individuals and you give them ownership. So let's say we have a corporation and we have 100 shareholders. Each one of them paid the company to buy a particular portion of the ownership in the company. And now they own the company. They can sell their shares to anybody else. In that case, they could get rid of their ownership and you would have a new owner. Or the company can buy back their share and the company would no longer have that shareholder as an owner, right? Usually, the company gives to the shareholders from time to time a portion of the profit that the company has made, and it's called dividends, right? So if the company made a lot of income, the company might pay the shareholders a portion of it, and this is called dividends, right? Uh, let's say you buy a stock and the stock price is, let's say, 10,000 reals, and you own a portion of the company. If the company gives you a dividend from the income of the company, your ownership would not reduce because of that dividend. It's a portion of the profit that you're getting because you're one of the owners of the company. Whereas if you gave the company a loan, 10,000 reals, and they give you 2,000 reals back, that means now they only have a loan from you equal to 8,000 reals. No longer do they have a 10,000. But in the case of ownership, you continue to enjoy the ownership and then you continue to enjoy the income. But your money that you own, that you paid, will not be paid back to you until you sell your portion of ownership to somebody else. Okay, I hope this is clear. Yeah, you can stop me anytime if you have a question. So
Doctor, I
this,
just wanted to
yeah, go
share
ahead.
an example. So the company that I work in is a publicly listed company, which means that investors can buy shares and be able to invest, be owners. And so every quarter there's a financial report that is
Mhm.
sent out, and it's public to everyone. It has public information, and again, this is where it's ethical to report the right numbers, and also they get dividends. So everything is making sense now because I was only involved in the HR side of it, but I would always
Right,
hear about everything that the company does in terms of investors. So now
right,
it's all coming together. So I just wanted
right.
to share that.
Alhamdulillah. Very good. Excellent, excellent. Very good. Inshallah, and it will make even more sense as you go forward, inshallah, in all aspects, inshallah. Okay. The second type is investing activity, which involves the company investing in resources. For example, the company buying computers or trucks or furniture, building, etc. And when the company invests, it ends up getting an asset. So all of these things that the company buys, it could be a stock in another company as well, right? So one company can own shares of another company. In that case, that stock is going to be an asset to the company, right? So investing involves um, buying assets. Buying and selling the company's own stock is financing activity, but buying the stock of another company is investing activity. So let's say Microsoft sells stocks to the shareholders, that would be financing activity. But Microsoft, let's say, goes and buys shares in Sony or in Apple. In that case, that would be considered investing activities, right? Okay, so buying assets uh, that the company would own is in the investing activity. And the third is operating activities. When a business has the asset it needs, it can start operating. Here you have the revenue, obviously, the sale to the customers and getting money from the customers is an operating activity. Buying inventory, right, to sell to the customers is in the operating activities. Accounts receivable, right to receive money from a customer in the future as a result of a sale, right? This is the definition. This is what I told you. Right to receive money from a customer in the future as a result of a sale. So this is also, this activity is an operating activity, right? But the accounts receivable itself is going to be reported in the balance sheet as an asset, and the sale is going to be reported in the income statement, which is going to generate revenue. So you see the same uh, transaction, the same buying and selling would affect more than just one financial statement. All right. And again, it will make more sense when you start working on the financial statements, which we will begin a little bit in just a few minutes, inshallah. Any questions so far? So far, so good. We should continue. Okay. Uh, Operating activities also involve expenses. Any item that you have to pay for selling, for buying the goods, for marketing, for administrative expenses, anything that you have to pay for, it's an operating activity. uh, a liability arising from accounts payable. An accounts payable is the opposite of the accounts receivable. So if you buy something from another company and you haven't paid it yet, this would be accounts payable. So for example, let's say Lulu purchased a truck of milk from Baladna, and it has not paid Baladna yet. That means this is going to be an accounts payable on Lulu's accounting records. The same item is going to be an accounts receivable in Baladna's accounting records. So one company's accounts payable is another company's accounts receivable. Here, when Lulu buys the milk, they are the customer, and Baladna is the seller. So the seller has an accounts receivable from the customer, and the customer has an accounts payable due to the seller. Does that make sense? And then you have all of these other things that are due, wages payable, income tax payable, etc., etc. There could be a number of different types of payables, which are dues, which are payable, which you have to pay in the near future for some activity that you have done. And when you have revenue that exceed the expenses, we said that you have a net income, and when the expenses exceed the revenues, you have a net loss, right? So all of this is in the operating activities. Okay. Now, I have a small exercise here. Let's see. We have 6 items and we have 1, 2, 3, 4, 5, 6, 7 people. So let's take turns and we'll come back to the last person in the next exercise. The first item, Miss Ala, can you tell us cost of renting a property? What type of what activity would that be? Financing, investing, or operating? Cost of renting a property.
Financier?
Uh, okay, it's okay. It's okay. It is. We are here to learn. We don't have to have the right answers. Uh, the cost of renting is rent expense. So rent expense, it would be. Uh, what do you think, Miss Ala? If it's an expense, it would be. Uh, okay, we have Miss Safia. Go ahead, Miss Safia. If you know the answer, go ahead.
The expenses falling under the operating activities.
Operating activities, very good. It's under operating activities, very good. Okay. Ms. Sausan, why don't you try the next one?
It's okay.
Truck purchased.
It's okay, doctor. I just wanted to answer. You want me to do the truck
The next
purchase?
one, do the next one. The truck purchased, what would you?
Sure. The truck purchase is actually an asset.
Okay. So which
Yeah.
activity would it be?
It will be also an operating activity. Yeah.
Think about it. Think about it.
Oh, sorry. The asset is investing. I'm sorry.
Investing. Very good. Excellent.
Yeah.
Excellent. That is
Right.
correct. Okay. Miss Mai, why don't you do the third one? The notes payable. What do you think?
Yeah, I was going to answer the second. Notes payable. Is it financing?
Financing. Excellent. Very good. You are all very good students, mashallah. Mr. Muhammad, why don't you do the number 4? Issuance of ownership shares. What do you think?
It's it's an investing.
Um, when we say issuance of ownership shares, we're talking about the company shares, not the share of another company.
Financial.
Financing. Very good. Excellent.
Financing, yes.
Excellent. Very good. Okay. Now, who's left? Who did not answer? Ms. Shaista, why don't you try the amount earned from performing service?
Liability
Amount
and
earned, right? So you provided the customer with some service.
amount earned, asset. It would be an asset.
You performed the
And
service,
investing.
right? You performed the service, right? You performed the service and the customer is going to pay you now. What is this?
Mm,
You're standing in line at Lulu and you're going to pay Lulu. What is that? Okay, it's okay. Don't worry. I think Miss Mariam has not attempted at anything yet. Mariam, you want to?
The amounts earned from performing would be operating.
It's an operating activity,
Yeah.
right?
Yeah.
Right. Very
Because
good.
it's revenue, you're making money.
Right.
okay.
Right. And the amounts owed to suppliers, right? Anybody wants to do that? Go ahead, Ms. Sausan, go ahead.
Yeah. Amount owed to actually liability.
Liability. Operating, very good. Now, amount owed to the supplier is operating, but if it's amount owed to the bank, that is also a liability, but that's financing, right?
Yes.
Very good. Excellent. Okay. Do you want to say something, Ms. Mariam?
No. That's okay. Thank you.
Okay. All right. Now, you see, I asked you the question which activity it belongs to. The exercise asks you actually to identify whether it's an asset, liability, common stock, revenue, or expense. And uh, by answering the operating or financing or investing activity, you already have to identify what type of item it is. Okay. Now, just let's go a little bit until 8 o'clock and we'll take a short break, inshallah, and we'll come back and finish, inshallah. Uh, we have, I mentioned to you the two statements. The first one is the income statement. The second one I mentioned to you was balance sheet. But in between here, we have a retained earnings statement and we have a statement of cash flows. So together we have four statements here. These four statements are prepared by every company, and we're going to discuss each one of them and what is included in each one of them in the following, inshallah. Let's start with an income statement. Income statement is the most simple statement that is prepared. It only has two types of items, revenue and expenses. And when you subtract the expenses from the revenue, you have net income. If the expenses are more, you have a net loss. So here, simply, when you look at this whole page, it might look a little bit busy, a little bit complicated. But what I would like for you to do is focus on two items. The first one is service revenue, is 10,600, which is the money that the customers gave the company. And then the second item is the 7,740, which is all the items that the company paid, right, during that period. And the difference between the revenue and the expenses is the net income, right? This is the net income. This statement is prepared for a period of time. So this says in the income statement, title would say something like Sierra Corporation income statement for the month ended December 31st, meaning all the sales that the company had from the 1st of October until the 31st of October is included here, right? This is for this whole month. If it said for the year ended December 31st, 2022, it would mean for the whole year, right? If it said the quarter ended, that means it would be for the 3 months. So this is for a period of time, for a number of days, right? So you have the income, and then you have all these expenses, salary, rent, supply, all of these different types of expenses added together to calculate the total expense, and it's subtracted from the revenue to get the net income. Clear? This is very, very simple. Any difficulty in ending this? This should be easy, yeah? But you can ask me if anything is not clear. Okay? All right. The next statement is called the statement of retained earnings. Now, the statement of retained earnings. What is retained earnings? Retained earnings is all the income the company has made from the beginning until the end of the statement date, minus anything that it paid out to the shareholders. So the company started at the beginning of this year, so it didn't have any retained earning before, which is zero, as you see. The net income for this month, which was October, which was the first month of operation, was 2,860. And then it paid out $500 in dividends, and the retained earnings is 2,360. So retained earnings is any income the company made from the beginning until now, minus any dividend the company paid out, right? And it would equal the end retained earnings. Retained earnings, earnings the company made and kept, hasn't paid out to anybody yet. Is that clear? It's a slightly bit more complicated than the revenue and expenses.
I just had a question.
Yes,
The
go ahead.
zero, it's that the company didn't make anything for from the beginning of the year.
Zero is any company starts with zero, right? On the
Yeah,
first day of
they don't
business,
make any. Yeah.
at the beginning of the first day, you don't have any income. So that's the beginning,
Okay.
right? Now, let me ask you a question. When let's say I start another retained earnings statement at the beginning of November, what would be my beginning?
2,360.
Excellent, very good. So you understand. This is the retained earnings from the previous period's ending, right? So any period's ending retained earnings is the beginning of the next period's retained earnings. And this is true for any balance sheet item. Now, one just tricky question while you're at it. What is the time difference between the ending retained earnings and the beginning retained earnings of the next period? How much is the time difference?
A month
Hmm?
or since the beginning? It's gonna
So,
be since the beginning of when the company started up until that last month.
no, what I'm saying is, you see, the 31st of December is the ending retained earnings, right? What would be
Yeah.
the date of the beginning retained earnings of the next period?
October 31st.
October
No,
31st
It's
is the last day. What is
November
the first
1st.
day of the next period?
November 1st.
November 1st. So what is the time difference between the two?
one day.
One day.
Zero, we can say.
Yes.
Hmm?
0 day.
It's 1 second, right? So at
Yeah.
11:59:59, 11:59:59, it's October 31st. 12, it's November 1st, right? You
Okay.
follow?
Correct.
Okay.
Yeah.
Right. So the reason I bring this up is because any ending balance, right, in the balance sheet becomes the beginning balance in the next period, and the time difference is split second, right? It's just an instant, right? Okay. Uh, Moving along, this is the retained earnings and the connection between the two statements, the income statement and the retained earnings. As you see, this 2,860 is the net income, which is added to the retained earnings, right? When we go to the next month, we would have the beginning retained earnings as 2,360, like Miss Mariam said, and then the net income would be from the month of November, right? And we would do the same thing over and over again, right? Beginning, ending, like that. We will continue. So this is the interrelationship between the two statements. Is that good? You follow?
Yes.
Okay. Uh, the next statement is the balance sheet, and as you see, uh, in any business, the assets minus the liabilities equals the equity, or you can say the assets equal liabilities plus the equity. So here you see these items, and it's not necessary for you to understand every single one of these items what they mean, but if you go here, you see anything that is an asset is listed here: cash, accounts receivable, supplies, prepaid rent, equipment, and then any liability that the company owes is listed here, right? Notes payable, accounts payable, and all these other payables adding up to this amount. And then you have common stock 10,000, and then you see this retained earnings, right? This retained earnings, do you remember this? This comes from the money that the company made, and it has not paid out to the shareholders yet. So this 2,360 comes from our previous statement. And if we come here quickly, I'm going to go back to that slide in just a second. You see this retained earnings 2,360 comes from this statement that we have discussed in just a couple of minutes ago. As you see, this 2,360 comes from this retained earnings statement. So in essence, the retained earnings statement is a part of the balance sheet itself, right? If we go back here a little bit, you can see the assets equals liability plus stockholders' equity, or you can say the assets minus the liabilities equals the stockholders' equity. Now, the thing that is to be noted here is the income statement is for a period of time. So when you look at the income statement, when we come back here, this $10,600 is the sales that the company had for the entire month of October, from the 1st of October until the 31st of October. But when you come to the balance sheet, each one of these items is on a particular day. It's not for a period of time. So when I say the cash is 15,200, it is the amount of cash the company has on the 31st of October, not for the whole month, because the amount increased and decreased throughout the month. The balance sheet items show the amount on the date of the balance sheet. At the end of the day, on 31st of October, the business had $15,200 in cash. Is this clear? The difference between the income statement and the balance sheet.
Yes, clear.
Okay. So the income statement, when I say I have 10,000 in sales for October, this is for all 30 days put together. When I say the cash amount is 15,200, that means this is the amount I have on that particular day. So it's as of a particular day. Okay. All right. Now we have the next thing we have is the statement of cash flows, but I would like to come back to that. I'm going to come back to that. What I would like to do is have a 15 minutes break, and or maybe we can do a little bit more, but based on what we just studied in the balance sheet, income statement, and retained earnings, I would like for you to use these numbers right here and look at the slides that we just went through, went over the income statement, retained earnings, and balance sheet, and try to prepare following that example. You can look at that and then take items from here and prepare an income statement, a statement of retained earnings, and a balance sheet over the next 15-20 minutes, and then we'll come back and I will give you the solution, and we will finish the rest of the material. Okay, does that sound good?
Yeah.
Okay, inshallah. So let's say at 8:20, you work until 8:20, and then we will come back and look at the solution, and then go back and finish the rest of the material. All right?
Okay.
Okay. Assalamu alaikum wa rahmatullah.